Hello everyone, welcome to Learning Made Easy. Today we're going to study our first chapter, Macroeconomics. The first chapter on macroeconomics. So, what all we'll be covering in today's lesson? Meaning of macroeconomics, the types of goods, gross investment and depreciation, and another one small exercise for us all to test our knowledge. Now, what do we mean by macroeconomics? Now, economics, as we know it, it studies economic problems. It studies scarcity of resources, problems of allocation of resources. Macroeconomics also studies the same thing, the same problems of economics, but it studies at a level of economy as a whole. It studies on a much larger level. Now, as we said, what all questions does macroeconomics study? It mostly deals with the social welfare, such as employment, growth of output, inflation, depression, and so on. Now, what are the differences between micro and macroeconomics? Micro, as we know, studies individual units like an individual consumer, an individual producer, and an individual firm like that. But macroeconomics deals with aggregate economic units. Microeconomics deals with the determination of price level and output. Determination of price level means by the forces of demand and supply, the prices are determined in the market. But macroeconomics deals with the determination of general price level and national output in the country. Micro aims at optimal allocation of resources, but macro aims at determination of aggregate output. In microeconomics, the macro variables are constant, are assumed to be constant, but it's the opposite in macroeconomics. The microeconomic variables are assumed to be constant. Examples are individual demand, supply, per capita income, etc. For macro, it is aggregate demand, aggregate supply, national income, etc. Now, we learned about micro and macro, right? So, in micro, the central issue or the central problem is the allocation of resources. That continues to be how are the resources to be allocated. For example, how will a consumer allocate his income to gain satisfaction? How will a producer allocate his resources in order to produce more goods? But in macroeconomics, it's the determination of overall level of output which is the central issue. Now, what is the method of study? This we will learn later in further classes. But in macroeconomics, it is general equilibrium analysis. But with micro, it is partial equilibrium analysis. Now, production process. This we will learn later in further when we study about the circular flow of income. But as of now, production process basically means all the activities that are used to produce goods and services, like all activities which are used to produce goods and services, by using the factor services. What are the factor services? By using land, labor, capital, entrepreneurs. This is known as the production process. Now, we learned about macroeconomics. We got a general idea on it. Now, the next unit of the chapter 1 is what are the types of goods? Well, there are basically three types of goods: intermediate goods, consumption goods, and capital goods. Consumption and capital goods fall under final goods. We will learn to differentiate between all of this in the next slides. Now, as we've seen, final goods include consumption goods and capital goods. Capital goods are also known as investment goods. Yes. Now, consumer goods. Well, consumption goods are those goods which are used by consumer for their personal use and are ready to use as they are. These goods are either consumed immediately or they are consumed over a long period. Now, these goods give satisfaction. There are basically two sectors in the economy. Actually, there are four, but we are only studying two. One are the households and the other one are the firms. The households are the consuming sector, but the firms are the producing sector. Now, these consumer goods give direct satisfaction to the households. Now, we will learn the four types of consumer goods. Yes, non-durable goods, semi-durable goods, durable goods, and services. Now, non-durable goods are simple, one-time use goods. Like, for example, apple, you eat it once and it's non-durable. Semi-durable goods are those goods which last for some period of time. For example, your clothes. You wear your clothes for 6 months and then you go and buy another one, right? Durable goods are those goods which last for a longer period of time. For example, a refrigerator, electronic gadgets, phone, laptop, cupboards. Those things last for a longer period of time. And services. Well, services, these are many. Doctor's treatment, then the services of a CA, of a professional. These contain services. Well, yeah, these are some examples: semi-durable toothpaste, durable furniture, television, services, doctor service, mobile service. Yeah, now we learned about consumer goods before. Now let's learn about capital goods. Now, what are capital goods? We all know that capital goods fall under final goods, right? These fixed assets of producers which are repeatedly used in the production of other goods and services. You need to understand that these capital goods help to produce other goods and services in the economy. They are not used in the process, but they help to produce other goods. Well, one thing is that capital goods are otherwise known as producer goods, but not all producer goods are capital goods. Well, capital goods undergo wear and tear over a period of time. Well, now I'll give you an example of capital good. Well, for example, an air conditioner in an office that's used to generate a service. What is it? Cool air, refreshing air. It's used to generate that service, and hence it's a capital good. Machinery in a factory. It's used to make more goods and services, and hence it's a capital good. Well, yeah, all machinery, equipment, even factories that are used to produce consumer goods fall under this category. Now we shall learn about the difference between consumer goods and capital goods. Well, you can go through this by yourselves. It's pretty easy. Basically end use, and then one thing is productivity. Consumption goods do not promote productivity, but capital goods promote production capacity, because when you produce more capital goods in the economy, then automatically your production increases. Next, the types of goods: intermediate and final goods, that we have already seen. Next, intermediate goods. We have so far seen the consumer goods, capital goods, and now we are seeing the intermediate goods. Well, intermediate goods are those goods which are still in the production process. Now, these goods are sold, and they're resold. These goods are those goods which value is yet to be added, and these goods have derived demand. And another thing, the value of these intermediate goods are not included in national income. This is something which we will learn in other later classes, but the value of these goods are not included in national income. Now, for example, a milk purchased by a dairy shop. The milk that the dairy shop purchases are meant to be resold. They will be further processed in the production process, in the production cycle, and they are used for making sweets or other things, other goods, and hence they are intermediate goods. Now, yeah, final goods. Now, final goods, as generally speaking, those goods which are either for consumption, that is the consumer goods, or for investment. Now, goods purchased by consumer as they are meant for final consumption, but goods purchased by firms as they are meant for investment. Final goods are those goods which the value is added in the national income. We saw in intermediate goods the value is not added, but in final goods the value is added. Now, this is an example of how to differentiate between consumer goods and intermediate goods. Now, a farmer produces wheat and sells to the milk owner. Well, it's an intermediate good because it's resold. A milk owner produces wheat flour and sells it to the bakery. Value is added, it's resold, it's still within the production boundary. Bakery produces bread and sells to the consumer. And finally, the final good, until it reaches the consumer, it is still an intermediate good. But once it reaches the consumer or the firm, it may be termed as capital good or a consumer good. Now, we shall go more ahead. These things are not that important, and they are a little complicated also. I shall explain them in the later classes. Yes. Now, a very important concept: how do you differentiate between final goods and intermediate goods? Well, you guys can go through this. It's easy. It's basically the things I've said before already. Only one thing I'll explain is national income. Sorry about that. Sorry about this. Just second. Yeah, now I'll only be explaining about national income, about why is it included in the national income and why are we not including it in the national income. Now, if you take, for example, intermediate goods, as we saw earlier, wheat. that the farmer produces, he sells to the bakery, and bakery produces the bread, and the bread reaches the ultimate consumers, right? Now, before it reaches the ultimate consumers, the value that is keeps on adding, it leads to double counting, because from wheat the value is added, then it reaches the next person, that person adds more value to it, then it reaches the bakery adds more value by making it into bread, then the bakery may sell it to another retailer, the retailer adds further value to it. So the value that was there from the wheat, until before it reaches the consumer, value is still added, and it leads to double counting, and hence it is not right to use it in national income. But final goods, those goods are not resold, those goods value is not added, it will not be further added, and hence it can be used in national income. We'll study this in later classes. Now, a small exercise. Yes. Now, wheat flour, is it a final good or an intermediate good? Well, wheat flour depends. If it is in the hands of a producer, it's definitely an intermediate good, because it will be used further in the production boundary and it will be resold. But if it is in the hands of a consumer to make chapati, then it's a consumption good, because it's for satisfying consumer needs. Machine, this also depends on the circumstance. Machine, if it is with the producer for final investment, it's a capital good. If it is used to generate other goods and services, it's a capital good, it's an investment good. But if this machinery is used is itself used in the production process, if this machinery is itself resold, then it's an intermediate good. But for example, fan that is in your home, then it's a consumption good, because it's for generating, it's for satisfying the consumer's direct needs. Then books for a library. Well, this is a tricky one, but books for a library is an intermediate good, because it is used for generating income. Sorry, it's not an intermediate good, it's a capital good, because these goods are used for generating services to the public, which is in turn generating some income. Cement and bricks, well, these are intermediate goods, because they are further used in the production process that is used to make a building or some infrastructure. Chalks, dusters purchased by school, well, these are capital goods, these are investment goods made by school, simply because they are used for satisfying the services of the teacher that is used that they use in teaching. Expenditure maintenance on a building, well, this depends also on the situation. This one I'm leaving it to you guys may solve it. Yes, now we have seen about the types of goods, that is the consumer goods, capital goods, and the intermediate goods. Now the next new concept is stock and flow. Really easy concept only thing, the examples may be a little tricky, but once you know the concept, you can get the hang of it. Stock is the quantity measured at a particular point of time. Okay, stock is the quantity of an economic variable that is measured at a particular point of time, but flow is the quantity measured at a particular period of time, say a week, a year. Now, since stock is measured at a point of time, it does not have any time dimension. You can just measure it at any time. There's no time related to it. But for flow, it has time dimension, because it is measured over a period of time. Say it can be measured over a week, or over a month, over a fortnight, over a year, etc. Example of stock is, well, for account students, balance sheet of a company is a stock variable. Stock of raw material is a stock variable. Now, for flow, the profit and loss account, that's a flow variable. National income of a country, that's also a flow variable. Now we shall see the differences between stock and flow. Now, what is the meaning? Quantity of an economic variable measured at a particular point of time is stock. But flow, this we have already seen before, quantity of an economic variable measured over a period of time. Now I already told you why stock has no time dimension, but flow has time dimension. Now, since stock does not have any time dimension, it is a static concept, but flow is a dynamic concept. Example, wealth, balance sheet, investment, profit and loss account. Now, this one I'm leaving it to you guys. Put the answers in the comments down below. If you have any doubt, please contact me. Now, next, we saw about stock and flow. Now, the next important thing is investment and capital formation, right? Now, what do you mean by investment? Investment simply means, okay, I want to tell you one thing first. Investment can be of two types. Actually, there are many types. There are actually 4 types of investments. But broadly speaking, there are two types. One is the real investment, which simply means creating more fixed assets in the economy, you know, but a real investment. And the other one is financial investment. The investment that you invest in types of bonds or shares, that is financial investment. Now, the other two are gross and net investment that we will see later. Now, this one we are talking about investment or capital formation. We are talking about real investment, not financial investment. Now, investment means addition to the real capital stock, which raises the productive capacity of the economy. It means creation of new capital assets, that I told you, new fixed assets in the economy. It does not include financial investments or second-hand assets. It's important to know. There are no bonds, shares when you talk about this type of real investments or second-hand assets. Now, example of this is change in inventory. It simply means closing stock minus opening stock, construction of business premises, value of machinery and equipment. Now, we saw about investment. Now, let's see the next thing, depreciation, or otherwise known as wear and tear, or otherwise known as consumption of fixed capital. Now, depreciation simply means the gradual fall in the value of a fixed asset. It's the slow but gradual fall in the value of a fixed asset purchased by a firm or a household, any fixed asset. Now, what causes depreciation? Wear and tear, expected obsolescence, or accidents, usage, etc. Now we'll study about this next slide, wear and tear. Yeah. Now, if you use a particular asset for a period of time, they are expected to undergo wear and tear. Their value will automatically fall down simply because of their usage or because of accidental damages which cannot be made good by repair or maintenance. Now, expected obsolescence. It simply means the fall in value of a fixed asset. Sorry. Yeah. Never mind. I'll just explain it to you. Sorry about this. Yeah. Now, expected obsolescence refers to the fall in value of a fixed asset. Why? Because there are newer technology. There are advanced techniques of production coming up as time passes. So the techniques of production that we use, the technology that we use becomes outdated and hence its value falls. That's what we mean by expected obsolescence. Now we saw about investment, as I told you, gross investment and net investment. Now, for example, now this thing, I will just skip it. You guys can practice this sum. Next, gross investment. It includes the expenditure by the producers on the purchase of new assets as well as expenditure on the replacement of existing assets during an accounting year. Net investment, it includes expenditure by the producers on the purchase of new assets only. More specifically, it does not include expenditure by the producers on the replacement of existing assets. Now, an important formula is that gross investment minus depreciation gives net investment. Okay. Now, capital loss is not the same as depreciation. Loss in the value of assets due to calamities or unforeseen factors like war, theft, etc. is capital loss. Capital losses are met by insurance policies. Now, another sum. Yeah. Now, difference between capital loss and consumer depreciation, not that important. You guys can go through it. And finally, some practice questions. Put the answers in the comments down below. And if any doubt, please contact in the mail.